What's going on, guys? Today I have a very special video for you. We are going to go over credit spreads and how you can use them right now to capitalize on this volatility in the market. So the market just keeps tanking, and this is a great way to basically make money on the market, even though whether it trades sideways, kind of whatever happens. I'm going to show you a very conservative way where even if the market goes down a little bit more, you're not going to be put in a bad spot. And it's a way that I've kind of continued to use and I've adapted into my basically overall portfolio over the last year. And it's kind of worked out for me relatively pretty well. So I'm going to show you guys how I do it, how I set up trades, and then some of the trades that I put on basically this last week to net over 6% on basically the capital that I had to invest. So if you enjoyed the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. So as I mentioned in the intro, one of the most important metrics that you need to look at, especially when you're selling any type of options, whether it's credit spreads or just normal puts or whatever it may be, is VIX. And VIX is basically tracing the volatility of the market. So another index is kind of what they call it is it's a fear index. So as people become more fearful, the VIX tends to go up. Basically, as people sell more, there's more volatility, more kind of people, more volume in the market, you'll see the VIX go up. So overall, what you're looking for, the VIX is also, it's important to note that it's mean reverting. So it tends to revert back to kind of a stable level. You can kind of see in here, right, it goes and spikes up, and then it always reverts back down to a very kind of like stable level that you're seeing in here. People tend to say around like 15 to 20 is where it reverts back to, and most people like to sell options kind of over that 20 mark, especially over 25, and right now we're at 32, and you can kind of see how many times over the last 5 years we've actually been above 30. You can see back here the trade war going on, and then in late 20, or sorry, this was the trade war, late 2018, and then early 2019, and then we have the 2020. Obviously everyone knows what happened there, and then we had that volatility kind of stick around throughout the year because there were a lot of things going on, and then we have that more recent volatility in here with all the interest rate news, and then most recently, right, we have the war kind of that's going on and everything that's happening overall with the economy. So a lot of volatility right now, and it's important to note that when you're putting on spreads like this. So we're going to take a look at, I put on, what is it, basically 3 trades, but each trade I did a quantity of 2. So in reality, right, I put on 6 trades. And when I did them, I just wanted to kind of give you some background. So we're going to look at this kind of SPY chart, right? I'm trading them on SPY, which is the S&P 500 index, and that has the largest volume and is basically the most liquid options trading stock on the market. So that's important, as well as picking a stock that you have a lot of liquidity in and basically can get out of trades on. So I'm not going to go too into depth on why you should, some of those nuances there, but overall that's kind of something that you should understand. But really, I put these on towards the second half of Monday. So at Monday, I saw the market kind of dipping quite a lot, and I hadn't put on a lot of these spreads recently. I've been focused on basically selling puts below stocks that I really like SoFi, Hood, some other stocks. But I figure it's kind of a good time to get back into selling some spreads. I was looking at my tax returns, and basically I saw that I actually ended up pretty well last year for the put spreads that I sold, and it kind of reminded me and got me back in the swing of wanting to trade these more. So on Monday, put on a couple trades, and basically, right, the market was going down, which means the VIX is going up, and just, yeah, you can kind of see where the market's at. So when I was putting on these trades, right, we were around kind of 420, and that's important to note as we kind of get into these spreads here on the next couple slides. So here we have all the numbers behind the trades, and what I'll do, I do have timestamps down here, or trade stamps that I will show you of kind of the trades on my account officially, but I've broken out all the numbers here just to give an easier visual of everything that's kind of going on with the trade. So when you're selling a spread, what you're doing is you're selling a put below kind of the current stock price, and then you're buying a put further out of the money. So right, I'm selling right here the 365, and then I'm buying the 360 put. And what I'm doing is, right, I'm selling this put for $2.87, 0.34, which just has to do with trade commissions, and then I'm buying this one for $2.51, and again, the 0.66 basically on the end. They're again having to do with trade commissions, but basically the difference between these two values is what you're collecting. So the difference between these two is 35 cents, 35, yeah, basically cents multiplied by 100, right? Because you're selling one contract, which is equivalent to 100 shares. So I'm collecting $35.68. And of a quantity of 2, that makes $71.36. So again, you can kind of see all of these, and I'm going to actually break them out on a chart here just to show you basically how far out of the money this really is. These I'm trading at a delta, which is basically delta tells you what is the likelihood of that basically ending up in the money, which means basically you losing money is kind of what it comes down to. So these are all at a delta of around 0.1, which means there's a 10% chance that I lose money on this trade. So a 90% chance that I actually, you know, the trade closes basically worthless, which means I keep all of the money that I collected and I don't have to, you know, buy back the trade. So overall, you can see, right, we talked about that. We were at 420 is where we kind of traded all these spreads at, and the highest one that we're in at is around 30, right, $360. So overall 300, I guess if you go 365 here, right, all the way up to 420, we can do that math real quick. So this would be 420 minus 365, you have $55. And if we take 420 here, and let's just take this divided by this, so you can see that's a 13% downward move. So we're already down 10%, a little over 10% in the SPY. You'd have to go down another 13% just to be at the top trade here. So overall, that's a very, very conservative number. You can see how far and how long it takes for the market to move down that far. Usually it takes quite a bit of time. Obviously in 2020, we saw it move down very unprecedentedly fast. But overall, you know, it's a very conservative approach. So again, if you look at these other two trades, so I collected $35.68 on the first one, and then I collected $28.68 on the second one, and then $27.68 on the third trade, and for basically a total of $184.08. And I traded a quantity of 2 of each of these, which they're $5 wide spreads, as you can kind of see here. So overall, this was $1,000 basically per each of these trades, so $3,000 in total, which comes out to, when you divide this number by this number, 6.14%. And all of these trades, I think the longest one was about 45 days out, and I think that was this trade at $345, or yeah, $345, and then this one I think is closer to around 30 days out. So basically in a month to a month and a half, I will collect 6% on the invested capital. So that is huge. If you did that right annualized, so if we just take this number and multiply by 12, you can see that we would have a 73% return, which is absolutely insane. That would be an insane return. But again, you'd have to have extremely high volatility for a long period of time, which is not, you know, what happens. Over time, if the market kind of levels off at where it's at, then volatility is going to collapse and come down over time. So we can't really expect that return. It's just crazy, right? I can get a 6% return, even if over the next, you know, 9 to 10 months I only collect 4%, I'll still be basically at pace with the market, and 4% would be just a very, very low number. I think we could basically do quite a bit better than that. I'm seeing around 20% year over year return so far when I'm trading spreads, and that's in a low volatility environment. This is obviously quite a bit higher volatility environment, and I think we can capitalize on that and make it quite a bit of money. So I'm gonna jump into a trade here. I'm gonna pull up the screenshots first, and I'm gonna show you kind of on the graph how this actually visually looks. So here we have the screenshot of a couple of the trades, and then we'll jump into the last one down here that got cut off. But but basically, right, you have the 360 and 365. So like I said, we bought the 360 puts and then sold the 365, and then here's where that number is coming in. So we bought this for the $2.51 and then sold these for $2.87. And then the delta, as I talked about, this is a couple days after I actually put the trade on, so the delta's already gone down because the market's kind of rebounded today. So overall, you know, that helps the spread. And then we've also, as I mentioned, right, this is around the 30 days that I mentioned. And then the longest trade is around 45, as I said. So in a month and a half, right, we'll be able to collect that. Assuming the market doesn't go below these strikes, we'll collect that full 6%. So let me jump over real quick to the second one here, and you can see this other trade. So like I said, it was cut off. So you had the 345 and then the 351 down here. So those are the ones that are closer to the 45 days to expiration. So overall, that's just kind of a quick little screenshot of the trades actually in my account, my TD Ameritrade account. So here's the last thing up here that I wanted to go over with you guys. I wanted to visually kind of show you, I'm definitely a visual kind of learner and like looking at things visually and seeing how they would all, how it kind of lines up against the market. But basically what we have here is this is SPY, again, what I put the trades on. And these are actually, it's important, very, very important to note, we are on the 3-year weekly candles. So each of these candles represents a week, and then basically overall, right, we can see each year. So we have 2019 here, we have 2020, and then we have basically 2021 right in here, and then right the start of 2022. So, you know, this is the end of each year, is what we're seeing, right? At the start of 2020, we saw the big drop, and then everything's kind of rebounded since, and then it's just kind of been up since then. So overall, this is kind of the time frame that we're looking at. Basically over the start of the year, we saw all the inflation concern, or inflation plus the interest rates increasing, kind of those concerns that drove the market down. And then in the last kind of week or so, we've seen kind of the war situation going on and you know, occurring, and seeing what's going to play out with that. So overall, right now the market seems to be at a very kind of it seems like there's some support here that you can kind of see previously in here, and it looks like even a little bit lower there might be a little additional support kind of right in here that's kind of holding the market up, and then some even more additional support in here, and then this box that I drew here, right, like we said, you can see over here on the right hand side, our first spread was put on at 65 to 60, 365 to 360. So the market would have to retrace all the way down into this zone for us to actually, you know, officially lose money, is I guess how I would put it. So you can see we've already gone down right this far, from highs of almost 380 to, you know, a low in here of, what does that look like, around, you know, 410. So the market would have to drop significantly down just to get into this zone, and it would have to do it relatively quickly, because, you know, if you move out a little bit in time, you move out around 30 days, which right now we're at the 9th. So if we go to like the 9th of April, here's I guess the 11th of April. So basically, right, in just a couple candles, I mean, you could see how short of a period that is, and maybe like 4 or 5 candles, the market would have to go all the way down to here. So we would have to have 4 or 5 candles, basically just like this candle, which has been the worst candle. If you look at really over the last kind of 2 years, this is the worst candle that we've had. This one's kind of close in here, other than, you know, back in the start of 2020. Obviously, this is definitely worse than that candle, and this candle, you know, not great either. But overall, this is the worst candle that we've had, and we'd have to have 3 or 4 of those just to get down to hit this first spread. So, and we have ones even, right, like we talked about, all the way down to, I think it was 345 was kind of the bottom one, so all the way down in here. So not much further down, but overall, to make 6% on your money on, you know, a very safe bet like this, I think it's a very positive thing. So I think it's definitely something that's worth kind of considering and moving into your arsenal. I've talked about this in previous videos. I don't think you allocate like your entire net worth to doing this, because it is a high volatility strategy. Obviously, as the market tanks down, these spreads will basically be affected more than, you know, stock. You'll see the volatility go up, and you'll lose, quote unquote, like on paper, lose money quicker than if you had stocks or shares of a stock. So you have to kind of be able to stomach it. I think it's good to, you know, start off with a few $100s. You can trade these spreads. I like the $500 wide, $5 wide spreads, but you can trade them only $1. You'll collect a little less money, but it's still a good way to get exposed, kind of get a feel for it, and then, you know, work your way up. So overall, I hope you enjoyed the video. I hope you guys got something away from it. If you have any questions or comments, just leave them down in the comment section, and I'll make sure to answer them. But again, I hope you enjoyed the video. If you did, make sure you drop a like down below, and if you want to see more videos like this one, make sure you hit that sub button. Otherwise, have a wonderful rest of your day.